So I am back. I was on a short trip. I was out of town, out of Mumbai. So I was not able to record. But now that I am back, the process begins again. The recording begins again. And some positive news I have for all of you. I received my SEBI RA license number. I have not yet received the certificate. I have not been empaneled yet. That is what I learned from their email. But at least the license number is there, and my name is listed on SEBI RA list on their website. So I think the work is done. I had given that exam in 23rd of February. So it took some time because my documentation was not ready. So it took some delay from my side, but finally it's done. So just waiting for the certificate. Then I will have to appoint a compliance officer. Then I will have to see what are my legal options. I mean, what is the type of content that I can produce? What is the type of content that I should not be producing? What should I be careful of in terms of compliance? All those things need to be looked at. So I need to hire someone for that. I can do it on my own, but it's better that I outsource it. But anyways, coming back to our learning, that's a little digression that I took. Have a look at this chart. Currently, we will only look at old time frame charts till my certificate comes. After the certificate comes, I will begin to update the content. I think this is good news for all of you, for my students and subscribers. This would allow me to discuss charts with latest 3 months data. And anyways, I wouldn't get into stock advisory or giving investment advice or writing research reports. I'm not going to go into those businesses. So the license is just for credibility purpose. I am not going to use that to give buy sell recommendations for a fee. That is not my business. I am an educator. So coming to NHPC chart, this is an old time frame chart. So as per the regulations, we can discuss this. Now, if I draw the base, you see how many points are there in the base. Let's draw the points. Point 1, it's point 2, point 3, point 4, point 5, and point 6. There are 6 points in the base, which is fantastic. So the buy point would be the high of this candle, which is 55.40. So 55.40. And you see there are a couple of candles that have closed inside the green zone. So this stock does have green zone closing. Now I want to discuss this chart with you because a lot of students still don't understand the logic behind drawing this green, blue, and red. Okay, so let me explain that we have divided this base into uh, 3 parts. The red zone is the lower half. The blue and the green zone comprise the upper half. The green is the top 25%. Then the next 25% is the blue. The reason why I created this originally is because there is overhead supply coming from here. So, for example, why do you think these two candles are showing long upper shadows? Upper shadow or upper wick, whatever you want to call it. Well, it's because the people who bought the stock here have been sitting on a loss for from 14th September till about 22nd November, right? From September till November, almost 2 months. For 2 months, the people who bought the stock in this area, they have been sitting on a loss. So their patience is running out, right? They by the time the stock reaches here, these guys, if they have not yet sold, they have given up hopes of profit psychologically. So they want to just get out of the stock. They just want their capital back. For that, they have been waiting for 2 months and they have suffered emotional pain during this downfall with their capital, right? And they have survived that emotional pain, held on to the stock till it comes here. And when it reaches here, they want to quickly get out at break even. That is called as overhead supply. And all along the as the price goes up, all the people who bought the stock from point one to point two, they are all there waiting to sell. I'm talking about the short term traders or investors. I am not talking about the long term guy. The long term person has it doesn't care what happens in 1 or 2 months. The long term person, even if you bought here, he wouldn't look at the stock for the next 5 years because that decision was made based on fundamentals, not based on charts. So that is the reason why we need to look at the blue zone, green zone. The higher the stock is trading, the better it is, because if there are green zone closings, which it means that the stock is able to absorb the supply that is coming from these buyers. Another another chunk of supply that is coming here is the people who bought in this area. See, now they have seen the price go up. Okay. And now they see that there is resistance coming here. So before the resistance comes, these people, the people who bought here, might want to get out. So here the supply is coming from buyers here and the buyers here. Imagine you bought the stock here. Now your target could be this level or maybe this level or whatever your technical analysis method is. But you have now have a sizable gain. So let's say you bought the stock at the close of this candle and now you are sitting on a gain of like 13%. And now the stock is approaching resistance. You are afraid that the stock might fall and you might lose your unrealized gain. You look at this candle, look at the upper shadow. That shadow will scare you away. You will think that, okay, maybe the stock might start to fall. So you might want to get out there, right? This is pure trading psychology. So it's just because psychology that you see long upper shadows here. Long upper shadows means bearishness. Upper shadow means bearishness. Lower shadow means bullishness. Okay. That is the reason why we need to watch the green, what happens in green zone, what happens in blue zone very carefully. Now, the only way the stock could go up, please listen to this carefully. The only way the stock could go up is if the demand pressure is more than the selling pressure. If the demand, which is coming in the form of high volume, if that demand is able to absorb all of this supply, then the stock has no way but to go up, right? So, for example, the supply coming from here is, let's say, 25 million shares, but the demand coming here is like 55 million shares. So, that 20 million shares will be absorbed very quickly. On top of that, you have another 35 million shares of buying power coming in, right? So, that the price will not fall because there is demand that is supporting. There are buyers who are more powerful than the sellers. The buying conviction is more than the selling conviction. If that happens, only then the stock would go up. So that is why I keep saying high volume rally, low volume consolidation, high volume breakout. We need the breakout to happen on high volume. Why do we always keep saying high volume? It's because you need to absorb the overhead supply that is coming from here. You need to absorb the supply that is coming from people who bought here. And who will bring that volume? Well, the institutions will bring that volume. How do we know that institutions might come into this stock? Well, we have done that in our filters. Remember, there is an accumulation distribution rating filter in our evergreen filter on MarketSmith. It has accumulation distribution rating of A or B, which means this stock is under institutional accumulation. Okay. That is why institutional demand can come up and push the stock up and break this resistance. Whatever supply is coming from here, it's likely to break. Another reason why that is so is because this is a stage 2 confirmed uptrending stock based on the moving averages. This is number one. Number two, I always keep saying that whenever you draw the base, you look at the yellow line, which is your buy point, and look at the closing price. Okay, the smaller the distance between these two lines, the better it is. Why? Imagine the distance between the closing price and yellow line is say 8%, and the stock next day shoots up 9%. How much do you make? You make only 1% because you bought at the yellow line. Correct? Let me repeat that. Imagine the distance between yellow line and closing price is 8%, and the stock shoots up next day 9%. You bought at the yellow line, so you will make 1%. You will not make 9%. That is unfair, right? The stock makes 9%, but you make only 1%. That is not fair. So the distance between the yellow line and the closing price should be as small as possible. Number one, preferably less than 5%. That is the convention that I use. If it is more than 5%, I just reject the stock. I just wait for it to close in on the yellow line. That's point number one. Point number two, I prefer both of these lines to be either in green color, which is fantastic. That's the lowest risk combination because even the closing price has gone into the green zone now. And then I prefer both the lines to be in the blue zone, right? So that they are at least close to each other, although there is no green zone closing. There could be green zone closing, but finally the stock has reached a level where the buy point and the closing price both are in the blue zone. If both lines are in the same color, that is a squeeze, right? Chances are the percentage difference between the two lines is less than 5%. That is the reason why I say if both the lines are in the same color, that's a high probability trade, right? Preferably it should be in green color. So if both the lines are in green color, your risk is low. If both the lines are in blue color, your risk is relatively higher compared to if both the lines were in the green zone. Moreover, if the buy point is in the green zone, closing price in the blue zone, again relatively higher risk. If the buy point is in blue zone and the closing price is in red zone, again your risk continues to go up. So lower these lines, higher is your risk. Upper the lines, more higher the lines, lower is your risk. It's very simple. It's not complicated, right? That is why we need to study the base in detail so that we know that what we are getting into is more risky or less risky. And of course, you have to do comparative analysis, liquidity analysis, technical analysis, fundamental analysis, and market analysis before you take an entry in this kind of a base. You can't look at this chart on a standalone basis, say that there are 6 points in the base and I'm going to take the trade. That is not going to work. Every other stock will form a base. Even a stock with relative strength of 45 could form a base and be in a confirmed stage 2 uptrend. But since the relative strength is less than 70 or 80, we are not interested in the stock because the market is doing better than the stock. So you need to understand these things before you pull the trigger. Moreover, you see the mother baby candle combination here. I had taught you mother baby candle combination earlier. There is a mother baby candle combination. The high and low is within the high and low of this bar. And that's a powerful combination. That's called as a squeeze, or that's called an inside bar in the Western technical analysis. And these are all favorable criteria. One criteria which is not favorable is the 50 moving average has gone flat. Ideally, entire base price action should be above the all the three moving averages, and all the three moving averages should be sloping up. That would be the ideal scenario. That would be the ideal Mark Minervini VCP kind of a setup. Mark Minervini would probably wait more for the stock to consolidate further, but I use a point system which makes it very easy for me and my students. This is still a valid buy point which can be considered. You could buy half position here, then buy another half when it is trying to break the weekly pivot point. There will be a weekly line, right? Maybe the cup with handle with the high of this as your pivot point. So you get multiple opportunities to buy the stock as it is coming out of the base as you observe the volume. So if I move the price forward, look at that. The supply that is coming from here is absorbed by extraordinarily high volume. The average volume was 21 million, 22 million, but the actual was 66. That is exactly what I was telling you, that the volume coming from here could be like 10, 15, 20 million, but 66 million is more than enough to absorb that volume and push the price up and make it close above at least the buy point, if not above the base. Even this candle, although it looks like a red candle, but observe carefully, it's a high volume red candle. If you look here, the stock has shot up 1.86% on twice the average volume. So even though it's a red candle, it's a very bullish candle and the stock has closed outside the base. So you need to understand uh, by looking at the candle whether this is bullish or bearish. Okay, just because it is red doesn't mean that it is bearish. You continue to move the price forward. See, very strong bullish action showed by the stock, right? Continues to remain above. Now, depending on whether it's a positional trade, swing trade, you would look at moving averages to mark your exit levels. If it's a positional trade, you will hang in there as long as the price is above the 50-day SMA. If it's a swing trade, you might want to hang in there as long as the price is above the 21 EMA. Very simple rules, nothing complicated. The orange trading system that I teach is extremely simple. If you just write down the rules, okay, there is a 50-part video series that I created on positional trading on weekly time frame chart that covers a lot of my teaching. So spend some time there. This is a daily time frame chart. Preferably take a trade on the daily time frame chart because there you get early entries. So in this video, I just wanted to recap the base, the colors in the base, and why I have placed those colors inside the base. It helps me identify how much risk am I taking inside this stock. I have seen stocks where the base is with the height of the base is very large. The green zone is also very large in size, and there is not a single candle closing inside the green zone. That's a risky base. So if I can understand before buying, if I can understand tentatively what is the risk I'm taking, I could keep a tight stop loss, right? Why would I keep a wide stop loss if I perceive that the risk in the stock is more? And if I perceive that this risk in the stock is less, the overhead supply is could get absorbed, I could keep a wider stop loss, give the stock some more time. So this is called dynamic risk management. I hope this video has been helpful. As usual, I am back to making videos. Keep sending me your questions so that I can use those questions to create more videos. I think that's the best way. Rather than me telling you what is going on in my mind, you ask me the questions and I will answer those questions. But study the system first before you ask me any question. If you do not understand anything that I teach, just shoot a question, send me an email, or just put it in the comment section. Somewhere I will read it. I don't have social media as of now. So some of my students have been saying that you start some social media. One of my students was talking about some Discord group. I don't know what that is, but let me think about it. Let's see. Once the SEBI RA license certificate arrives, a lot of options open up, and I will have to be doing things within the compliance boundaries. But I will see what can I do and what I cannot do online when it comes to content creation. And accordingly, the content will be updated. I think this is very good news for all of us, not just for me, but most importantly for you, because a lot of students were saying we need to be able to see latest 3 months data, not live charts, but at least the latest market conditions, what is happening. If I'm rejecting a particular stock based on what I teach, at least that I should be able to discuss. So, in that light, this is good news. Let's see. Let's see what I can do and what I cannot do. I will have to talk to my chartered accountant, my company secretary, some SEBI compliance experts, and accordingly, I will bring the best for you because I am committed to this. And these days, I think the market conditions are under pressure. As you know, if you have been following the system, then nothing, not much to buy these days. So it's just time to, sit back and relax. One of my students was saying that this system does not work when the market is under pressure. Well, I said this system is doing exactly what it should be doing when the market is under pressure. The system will automatically keep you away from a tough market because we have decided that in uptrend under pressure, we will not take a swing trade. We will only take a positional trade, and that too if it is technically strong coming out of an early stage base. So the criteria itself is so strong that it will automatically keep you away from uh, a market which is under pressure or a market which is uncertain because of global economic, trade policies, whatever is happening. The market is neither going up nor it is going down really. So in such kind of an uncertain market, if you don't get any opportunities to buy, it is very natural. In fact, your system should not throw up opportunities to buy in this kind of market condition. If your system is throwing up new stocks to buy, that means there is something wrong with your system. Right? This is not a market where you see huge volume coming into stocks. There could be one or two exceptions, but broadly, if you see stocks are not breaking out, so you just sit back and relax, don't do anything. The system is working for you. You might feel that there is nothing to buy, there's nothing to do, but the system that you have created, the criteria that you have written down for yourself is actually working for you. Okay. Thank you so much.